One of the biggest threats that your retirement plan faces hasn't had a great solution for many years, and yet a solution is emerging. Is this a risk that you should transfer? And if so, is this emerging solution the right way to do it for your situation? I got that and more coming up. My father-in-law loved to work. He typically worked 3 jobs at a time, and yeah, a couple of them were part-time. He had his main job, and then he had sort of 2 main jobs and had some flexibility, and then loved working in the evenings, weekends. We lived near Notre Dame, so that was his 3rd job, is helping out at the stadium and so on. And the guy loved to work, and everyone loved him. He was a hard worker, very friendly, and gosh, it was mid-50s. In one of his jobs that he had done for decades, he started not knowing, he wasn't as sharp, let's just say that, as he once was. And I remember Cindy saying, yeah, something's going on with Dad. And, it stood out, but it also was like slow over weeks and months. And maybe after 6 months, this pattern was, oh, this is alarming. What is happening? And then, 6 months turned into a year, and it got worse. And then I remember he was with this main job. He was transitioning from one department to another, and he couldn't transition. They said, yeah, why don't you move over to this department? And he couldn't fill out the paperwork. He couldn't do the job. He was just sort of spinning his wheels. And it was about that time, obviously things had escalated, that he was officially diagnosed with early onset in his mid-50s. Guys, this is extraordinarily unusual, tragic, and yeah, caught flat-footed. Who has a plan for getting Alzheimer's in your mid-50s and not being able to work in a family, and for a person who loved to work and loved to stay busy and do a lot of things, who was sort of the backbone of their family, and after a just heart-wrenching battle with this disease over about 6 years, he passed away a few years ago from battling Alzheimer's. And if you've gone through this, he wasn't himself for the past 3 years, for the last 3 years, and it was just awful trying to figure out what's best for him, how to care for him. At this age, my mother-in-law needed to keep working as well. We reached a point where he couldn't be by himself, and then eventually he needed around-the-clock care, and it was just, the amount of decisions and difficulty during this time, it just can't be understated, and it would be too long of a video to explain all of that. And we all, unfortunately, have stories like that now. And if you've lived long enough, you've had a loved one fight and battle this disease, and it's just extraordinary. And yet I bring that up because the risk of needing long-term care services, and I hate to even use that technical term, but the risk of not being able to care for yourself and needing some assistance with the normal activities of life, that is likely. It's either one of the biggest threats to your retirement and your the finances of your retirement, or it is the single biggest threat. Why? Well, there's a few reasons for that. One is that the cost of the care, if you need it, it's just extraordinary. The cost has skyrocketed. It was high decades ago, and it has absolutely just skyrocketed because more and more people need this level of assistance, and there is a shortage of the number of people that can provide the care. And therefore, just that's economics, that's supply and demand. The cost has just been extraordinary. And so more people have needed this care. Fewer people are providing that. That's caused the cost to go up. But the other reason why this is such a challenging issue for your retirement plan is health insurance, which I think logically, if you were first asked or quizzed, hey, does health insurance cover this? You'd say, of course it does. It doesn't. It doesn't. Medicare may cover some, they call it custodial care, where you're not able to get better, but just sort of help you maintain your condition. Medicare does provide for some of that, only if you've been hospitalized for a couple of days beforehand, and then they only allow for a certain number of days. And so if you are being rehabilitated after a surgery, that's sort of what it is. Like if you have a surgery and you're not going to be able to get back to 100%, but you need to recover from the surgery, that's what that care is there for. It's not there for you've got, cognitive impairment. And it's going to be a very slow but steady downhill climb. Health insurance and Medicare does not provide coverage for that. And when it comes to your overall kind of retirement plan, the nest egg that you've built up, your retirement income plan and all of that, I mean, this risk has the chance of punching a hole in the boat below the waterline. Because if you need care, the cost, it's no longer just a couple thousand a month. The cost for being in a facility in our area where I live, Midwest, which costs are very manageable, $10,000 to $12,000 a month. More than that if you need memory care. And gone are the days when you can just say, well, yeah, but if I need care, I'm not going to be going out and living, the go-go years of retirement. So instead of spending a bunch of money, that money will just be spent on my care and nursing home. No, those numbers are no longer aligned. The cost for care far exceeds the typical person's kind of normal lifestyle. And if you say, yeah, but I'll stay home and maybe, I'll have a family member take care of me and then maybe we'll hire someone in to come in because I don't want to leave the house anyway. Family members are more dispersed than they have been in the past, right? So not everyone is local like they used to be. They might have jobs or might need income. So my wife, she went down to just one day a week to keep her job, and the rest of the time she helped care for her dad. And that's not something that many people can do. And it was extremely taxing and challenging on her mentally and physically, by the way. And so that's typically not a viable option. And the cost of home care is thousands of dollars as well. So guys, this is an enormous risk and one that really is one of the biggest, if not the biggest threats to your retirement. So what do you do? Back when I started my career, this is 20 years ago, and again, this was too early for my father-in-law to really consider, standalone long-term care insurance was the primary way and the best way to manage this risk. Health insurance doesn't adequately cover this, right? Especially if it's cognitive impairment or a prolonged stay in a nursing home or prolonged stay or prolonged need for custodial care. And therefore, standalone long-term care insurance that really did nothing else except help for long-term care if this came up. That was the most potent and best way to manage this risk. However, it had two major issues to it. Number one, more people ended up needing to use their insurance than the actuaries actually projected. So therefore, the cost of the claims was far higher than what the original estimates were. So that was problem number one. Problem number two then is, well, because of that, insurance companies have had to continue to raise their prices on this. So if you have a standalone long-term care policy that you got a couple decades ago, oh my goodness, it's probably fantastic. I wouldn't make big changes, but you've probably received some notices saying your premium's going up because costs have been and claims have been much higher than they expected. They've been raising prices, and that has led to, those two problems has led to much fewer people buying this insurance, and therefore the standalone long-term care insurance market is likely, it's not a great spot. If you're looking at this risk, how can I manage it? Likely you're not turning to standalone long-term care insurance policies. I'm not saying you shouldn't. Work with your certified financial planner in your area for your specific situation. Maybe that's the right approach, but right now that seems like a rare solution. Fewer and fewer people are turning to those, fewer and fewer companies are offering them. So we've been in this for probably the last decade or so. We've been in a situation where this huge risk is there and it's growing, it's not decreasing, but there aren't great tools, there aren't great ways to manage this risk. Well, over the past couple of years, a new solution has been, I would say, has entered the scene and has gotten a little bit of attention, and that it is emerging as, hey, this could be a real viable solution to this risk. It is a life insurance policy that also has a long-term care feature. They call it a long-term care rider. Another way of explaining these policies, or maybe referring to these policies, is a hybrid life insurance long-term care policy. It may not be the right fit for you. However, it does solve a couple of the major issues that people had with standalone long-term care policies, and it does solve that, this major issue that, well, these standalone long-term care policies are much more rare. Well, life insurance policies, it's a very prevalent and stable market. Here's how they work. You buy a life insurance policy that has a certain death benefit, certain features, and so on, but you add on a rider that allows you to use some of the death benefit if you need long-term care services. So, and there's, criteria in, if you're unable to do 2 out of the 6 activities of daily living or have cognitive impairment, then you can use some of the death benefit. And you might say, well, wait a second, if I have this life insurance policy that's, worth $500,000 if I pass away, well, if I use, if I start using that death benefit for long-term care services when I pass away, will that $500,000 be there? No. It's, whatever you use during your life for long-term care benefits, your death benefit will be reduced by that amount. And so therefore, if you have a $500,000, for example, life insurance policy, and you end up using $100,000 for long-term care services, when you pass away, your beneficiaries would receive $400,000. Or if you end up using all $500,000 for long-term care during your life when you pass away, then there would be no death benefit. But because of this, it sort of offers this dual benefit. If you don't need long-term care services, well, then that death benefit is there for your heirs when you pass away. But if you do need long-term care services, well, then you can use the death benefit to help cover the cost of care during your life. And that manages one of the biggest tensions with that standalone long-term care policy is many people have said, well, wait a second, what if I don't use it? I've paid all this premium. Do I get anything back? No, you don't. But with a hybrid life insurance policy, it addresses that, where, if you don't use it for long-term care services, the death benefit is there for your heirs. That said, this is where you've got to work with your certified financial planner, understand that these tools exist, and hopefully this video helps give a broad explanation of that tool and how you might want to use it and how it works. But you got to work with your CFP because these still do have some challenges to them. They're not cheap, right? The second con with long-term care, standalone long-term care insurance is that it's pretty expensive. And this type of life insurance, you'd want a permanent type of life insurance, not term or temporary. You'd want permanent type of life insurance. And that can be fairly expensive. And then the other big risk with this is I mentioned that the cost of long-term care services is just skyrocketing. So the inflation rate is far surpassing the average inflation rate that we've seen for normal goods and services. And yet, when you buy a life insurance policy, that death benefit does not increase with inflation. So right now, or say in your 50s, you'd have to decide on a death benefit that, out there 2 or 3 decades later could mean a much smaller amount of coverage for long-term care services than you originally anticipated, just because inflation eroded that purchasing power. So it's not perfect. It still has some risks to it. And yet this appears to be the emerging way of managing this enormous retirement risk of needing long-term care. So is this a risk that you should manage? And is a hybrid life insurance policy the right approach for you to take, given your financial situation, your goals, your risks, the right approach for you to take to manage this risk? You got to work with your certified financial planner on this, who knows all 6 areas of your financial life, your goals, your present financial position, your tax picture, your retirement goals, your investment strategy, your estate plan. This decision rests at the intersection of all 6 areas of your financial life. So work with your CFP on that. If you don't have a certified financial planner on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.